There is a great illusion currently operating in global financial markets, an illusion that has convinced the majority of investors that everything is normal while the foundation of the monetary system is quietly fracturing. Nowhere is this illusion more dangerous and more deceptive than in the silver market. For years, we have witnessed one of the most baffling phenomena in modern economic history. We have seen hundreds of millions of ounces of physical silver vanish from the world's major vaults. We have seen industrial demand explode to levels never seen before. Yet, for a long time, the price on the screen remained stagnant. It defied the basic laws of supply and demand. It defied logic. But recently, that illusion has started to crack. As we analyze the markets in late 2025, silver has reportedly broken through critical resistance levels, crossing the $64 mark per ounce. To the casual observer, this looks like a peak. They see the chart and they think it is expensive. They think they missed the boat. But to the student of economic history, this is not a peak. This is barely the return to fair value. Most men between the ages of 25 and 65 are making a critical mistake right now. They are looking at the nominal price. They see $64 and think it is high because they remember it being $20 just a few years ago. This is a cognitive trap. You cannot measure the value of a hard asset using a currency that is being debased. You're measuring the length of a table with a ruler that is shrinking every single day. The breakout we are seeing in late 2025 is not just another chart pattern. It is the market mechanism breaking free from decades of suppression. It is the beginning of a price discovery phase that could redefine the value of precious metals for a generation. The mainstream media will tell you to be careful. They will call it a bubble. But remember who pays their bills. They want you in the stock market. They want you in paper assets. They do not want you owning the one asset that is independent of the banking system. So before you decide that silver is too expensive, let us peel back the layers of this illusion. Let us look at the cold hard math that suggests we are standing at the precipice of the greatest wealth transfer in history. To understand where we are going, we must first surgically analyze where we have been. History does not repeat exactly, but it rhymes, and right now the rhyme is becoming deafening. Let us look at the undeniable facts that the mainstream media often ignores. If you adjust for inflation using real government data, not the suppressed CPI numbers, silver at $50 or even $60 is still historically cheap. In 1980, silver hit $50. That was the legendary peak. But $50 in 1980 bought you a lot more than $50 does in 2025. If you adjust for the expansion of the money supply, if you adjust for the trillions of dollars printed since the 2008 and 2020 pandemic, analysts suggest that silver would need to be well over $200 just to match its 1980 purchasing power. So when people say silver is at an all-time high, they are looking at a nominal illusion. In real terms, silver is one of the most undervalued assets on the planet. But here is the critical difference between 1980 and today. This is the key to the entire thesis. In 1980, the Federal Reserve Chairman Paul Volcker had a weapon. To kill inflation, he raised interest rates to 20%. He crushed the economy to save the dollar. He forced a recession that broke the back of the commodity boom. He had the luxury of doing that because the United States national debt was manageable. Now look at the Federal Reserve today, in late 2025. Do they have the option to raise rates to 20%? Absolutely not. The United States national debt has exploded past $36 trillion. This is a mathematical trap. If rates went to even 10%, the interest payments on the debt would consume the entire tax revenue of the country. The government would default overnight. The bond market would vaporize. So unlike Paul Volcker, today's Federal Reserve is trapped. They cannot fight inflation with high rates because it would bankrupt the sovereign. They are forcing themselves to cut rates into sticky inflation. They are choosing to sacrifice the value of the dollar to save the bond market. This is the ultimate bullish signal for silver. There is no Volcker coming to save the fiat currency this time. The ceiling on silver prices that existed in 1980 has been removed by the sheer weight of sovereign debt. We are entering a period of financial repression where the government must keep interest rates below the rate of inflation to burn away their debt. This is the exact environment where gold and silver thrive. The safety valve is broken, and when the steam builds up this time, there is nothing to stop it. Now let us dissect the industrial beast that is devouring the world's silver supply. The mainstream narrative often suggests that as technology advances, we become more efficient and use less raw material. In the silver market, this is known as thrifting. Analysts have been predicting for years that solar manufacturers would replace silver with copper to save money. But here is the technical reality that shatters that argument. The solar industry is not moving backward to cheaper, less efficient technology. It is racing forward to higher efficiency. The old standard for solar cells, known as PERC, is being rapidly replaced by new technologies called TOPCon and heterojunction, or HJT. Why does this matter? Because according to photovoltaic industry data, TOPCon and HJT cells require significantly more silver per watt than the old technology. Some estimates suggest they use anywhere from 50 to 80% more silver paste. Why can they not just switch to copper? Because copper oxidizes. It corrodes. In a high-performance solar panel meant to last 30 years, copper is a liability. Silver is non-corrosive, and it is the single most conductive metal in the periodic table. It is simply irreplaceable by the laws of physics. So we are facing a paradox. To achieve the green energy transition, to build the solar farms that governments have mandated by law, we need to consume more silver, not less. The industry has hit the physical limit of how much silver they can remove from a cell without destroying its efficiency. Thrifting is effectively dead, and with solar installation rates reportedly doubling every 3 years, the demand curve is going vertical. But solar is just the visible tip of the iceberg. There is a darker, more secretive source of demand that is rarely discussed in public reports: the military-industrial complex. We live in a time of escalating geopolitical tension. In late 2025, nations around the world are rearming at the fastest pace since the Cold War. Modern warfare is electronic warfare. Every Tomahawk missile, every torpedo, every fighter jet, and every satellite relies on silver. Silver-zinc batteries are the power source of choice for aerospace and military applications because they have a high power-to-weight ratio and are incredibly reliable. When a government orders 1,000 new missiles, they do not care if silver is $30 or $300. They will buy it at any price because national security has no budget cap. This demand is price inelastic. Furthermore, this military inventory is often not reported in global supply and demand statistics. It's strategic. It is classified. This means the deficit numbers we are seeing from institutes like the Silver Institute might actually be understating the problem. The hole in the bucket is likely much larger than we think. Then we have the artificial intelligence revolution. AI data centers generate massive amounts of heat. Silver has the highest thermal conductivity of any metal, making it essential for the advanced cooling systems and connectors required in these server farms. As AI scales exponentially, so does the need for silver to keep the infrastructure from overheating. Now, let us look at the other side of the equation, the supply. If demand is exploding, surely mining companies are rushing to dig more out of the ground. The answer is a resounding no. We are witnessing a phenomenon geologists call peak silver. For centuries, we have mined the high-grade, easy-to-access deposits. Those days are gone. Today, miners are forced to dig deeper to find lower-grade ore. This increases costs and energy consumption. But the biggest problem is the byproduct trap. Approximately 70% of the world's silvers comes as a byproduct of mining for lead, zinc, and copper. This is a critical economic vulnerability. It means that silver supply is not determined by silver prices. It is determined by the global demand for base metals. Consider this nightmare scenario. If the global economy slows down into a recession and demand for copper or zinc falls, those mines will scale back production, and when they scale back, silver production falls with it. It doesn't matter if silver is trading at $100, if the copper mine is losing money on copper, it shuts down. This creates a scenario where a recession could actually trigger a silver collapse, fueling even higher prices. We are also seeing the end of the paper manipulation game. Let us analyze the crash of 2011. Silver hit $49 and then collapsed. Why? It wasn't because demand disappeared overnight. It was a coordinated takedown in the paper markets. The CME Group, which runs the futures exchange, changed the margin requirements 5 times in 9 days. They made it more expensive for speculators to hold long positions. At the same time, massive sell orders hit the market during hours of low liquidity. Major bullion banks, cited as analysts as the architects of this crash, utilized the paper market to smash the price. They sold silver they didn't have to drive the price down. And for the last decade, they've been able to keep a lid on prices. But there is a fatal flaw in the paper manipulation game. It only works if you have a physical stockpile to deliver when someone calls your bluff. In 2011, the vaults had metal. Today, the situation is radically different. Reports indicate that inventories at the COMEX and the London Bullion Association, known as the LBMA, have been drained systematically. We are talking about a decline from roughly 400 million ounces in COMEX registered vaults a few years ago to levels that are now flashing red warning signals. This sets the stage for a short squeeze of biblical proportions. If industrial users panic and demand delivery, the banks can't just print more paper contracts. They will be forced to go into the open market and buy physical metal at any price to cover their obligations. This is what turns a linear price rise into a vertical explosion. We have covered the illusion of the paper market, the anatomy of the supercycle, and the industrial stranglehold. Now we enter the final and perhaps most critical dimension of this analysis, the geopolitical chessboard. Silver is no longer just a commodity. It has become a strategic asset in a global economic war. For the last 5 years, we have watched the BRICS nations, led by China and Russia, systematically de-dollarize their economies. They are trading oil in local currencies. They are building alternative payment systems. And most importantly, they are hoarding hard assets. Where did that silver go? It did not just disappear, it moved. It moved from the west to the east. It moved from weak hands to strong hands. Why is China importing silver at record rates, while simultaneously rumored to be preparing to ban its export in 2026? It is not just for solar panels. It is a strategic move to corner the market on the energy infrastructure of the future. By controlling the silver supply, China effectively controls the cost and pace of the green energy transition in the West. If the reported export ban goes into effect in January 2026, it acts as a weaponization of the supply chain. It forces Western manufacturers to scramble for the remaining scraps of silver available outside of China. This creates a bifurcated market where the price in Shanghai might be different from the price in London, but the physical metal stays in the East. This aligns with the broader theme of the 2020s, the return of tangible value. In a world of $36 trillion in U.S. debt and teetering fiat currencies, nations are realizing that he who holds the gold and silver makes the rules. We are moving from a financialized economy back to a resource-based economy. The United States government has depleted its strategic stockpiles of silver decades ago. They have zero reserves. China and Russia have been building theirs. When the music stops, the nations with the physical metal will be the ones left standing. This is a transfer of power that happens once in a century. So, how does this endgame play out for the price? Let us look at the scenarios based on the data we have analyzed. Scenario 1 is the base case. This assumes no major geopolitical explosion, but simply the continuation of the current structural deficit. In this scenario, the sheer weight of industrial demand drains the remaining inventories by mid-2026. As the vaults hit critical lows, industrial users begin bypassing the COMEX and dealing directly with miners, paying massive premiums. In this environment, a target of $75 per ounce is not speculation. It is simply the price required to incentivize any new marginal supply. It is the new equilibrium. Scenario 2 is the bull case. This is the scenario where the system breaks. If the Federal Reserve is forced to launch a new massive wave of quantitative easing to bail out the bond market, or if the conflict in the Middle East or Eastern Europe escalates, disrupting supply chains further, then all bets are off. In a monetary crisis, history shows that silver often outperforms gold due to its smaller market cap. A rush of retail and institutional money into this tiny sector could send prices vertical. In this scenario, analysts at major banks have discussed targets of $100, $150, or even higher. It sounds extreme, but remember that silver moved nearly 1,000% in the 1970s. A move to $150 from current levels would actually be a smaller percentage move than what we saw in the past. But we must also address the bear case. What if we enter a severe global recession? Critics argue that industrial demand would collapse, crashing the silver price. This is a valid concern, but it misses the monetary reaction function. In a deflationary recession, tax receipts collapse and deficits explode. The government would be forced to print money on a scale that makes 2020 small. This currency debasement would likely trigger a flight to safety into precious metals, outpacing the drop in industrial demand. So even in a recession, the monetary case for silver remains the ultimate safety net. So what should you do? The window of opportunity is closing. The breakout above $64 was the starting gun. You have three primary vehicles. First is physical silver. This is your insurance policy. It is wealth that exists outside the digital banking system. It has no counterparty risk. If the power goes out, if the internet goes down, you still own it. Second is silver ETFs. They offer liquidity and ease of trading, but they come with the risk of the financial system itself. They are tools for speculation, not necessarily for long-term wealth preservation. And third is mining stocks. These offer leverage. If silver goes to $100, the profits of a well-run mining company could triple or quadruple, sending their stock price up 5 or 10 times. But this requires careful selection and a stomach for volatility. We are standing at a unique juncture in history. The math is undeniable. The deficits are real. The vaults are empty, and the geopolitical tension is at a boiling point. Many people will watch this video and do nothing. They will wait for a dip that never comes. They will wait for the mainstream news to tell them it is safe to buy. By the time it's on the evening news, the move will be over. The pattern is repeating. The setup is complete. The explosion has begun. The only question left is whether you will be a participant in the greatest transfer of wealth in history or just a spectator. This is not financial advice. This is a wake-up call. Do your own research, check the numbers, and decide for yourself if you can afford to have zero exposure to the one asset that is essential for the future of civilization. Thank you for watching.